For thousands of years, if somebody wanted to learn a new skill, maybe learn to make boots or horse saddles, how did they learn that skill? They studied with a master. Trade Maestro builds on this tradition, the relationship between the mentor and the apprentice, but we do it all online. The term maestro means master or an artist of consummate skill. And that's what a trade maestro is. It's a person who has mastered the art of trading. I didn't want to create just another stock market trading company that sells classes. I've done that, and I don't think that's in the best interest of my apprentice. I want to walk him through the process of becoming a great trader, and you don't get there with information overload. You get there by doing it, by getting your hands dirty, by putting into practice. That's the only way to build a new skill.
I love how Jeremy teaches. I love the fact that he teaches things in such a real, practical way.
And he made me realize that I can do this.
I remember when I first started my trading journey, and let's just say I blew up at least 2 accounts.
I know this model of learning to trade works. I've had the opportunity to work with people from over 80 different countries.
And I was skeptical at first. I was kind of like, okay, are you sure about this?
I was always chasing stocks. I would always chase the next top thing and never had an opportunity to get any profit from it.
I've helped people with trading accounts that are just a few dollars, and I've helped people with trading accounts that are over $1 million.
These courses give me a much wider perspective on what is really possible.
And what Jeremy does so well is that he breaks it down in a simple form so it's easy to understand.
They're just regular folks, and if I can teach them, I can teach you.
I didn't want to let someone else tell me what the play was, and I just followed their lead. I wanted to learn it for myself.
My greatest joy is when somebody that I have taught over the last decade, they reach out and they say something like, you won't believe it, but I actually have people that are asking me to teach them how to trade. Is that okay? You think I can teach them?
Working with you taught me that, stocks go through ups and downs pretty regularly and pretty predictable.
The portion that my husband has now been able to take over and own has outperformed the market and is doing better than the rest of our retirement. It is totally life-changing.
Just to think that I touched people, I taught them to do something, I influenced a generation of traders, and now they're taking it forward and they're influencing the next.
At the end of the trade, I ended up making 140%.
Just gives me so much delight and joy knowing that I can still do something with my financial future.
This is not something that's only for other people. I can actually become financially independent.
Not only allow me to make better trades, more lucrative trades, but have more confidence while I trade.
This Trade Maestro membership is excellent because it's got something for everyone. If you're just starting out, or even if you've been trading for a while, you'll find something you like. You need to get enrolled right now. It's affordable, it's comprehensive, and it's risk-free because you can cancel anytime if you decide you don't like it. So if you want to learn to trade the stock market, or if you're looking to take your trading to the next level, you need to get enrolled as a Trade Maestro member right now. The following presentation is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All examples are for the purposes of teaching and are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, and cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. Well, good morning, and welcome everybody to day number 16 of the Pick Winning Stocks Challenge. I'm Jeremy Hoyt,
founder of Maestro. I hope you're doing fantastic today, and it's great to have you joining me as we are going to get into quite possibly the most important topic we will cover in the Pick Winning Stocks Challenge. How many days have I said that? There's at least 2 days out of every week that rank up there with this is a life-changing message today, and today is one of those. In fact, when it comes to risk management, the stuff we're going to talk about today is actually the difference that made the difference for me. Well, it's one of 3 pieces, but you're going to get the first one today. So I'm looking forward to sharing it with you, and it's great to have you with me, and I think you're going to have a great one as well. So let's jump in before we get into the Pick Winning Stocks Challenge. Of course, if you haven't done so already, like and subscribe to the channel. If you're over on Rumble, follow. If you're on Facebook, follow. If you're on YouTube, like and subscribe. Share it with your friends and family. Tell them what's going on, and let's jump in and do some market analysis to get the party started. So you should be seeing my screen here. This is the Dow Jones Industrial Average. If you can see the little micro numbers up here, we are down 2 points. We were up a little bit earlier today, down 2 points. Basically, it's flat. S&P's pretty flat as well, and the NASDAQ is technically up about 78 right now as we speak. As you look at the chart here, if you can see this chart, you can see where we're sitting between our support and resistances, just hanging out on this moving average here. And you can see the very, very small candlestick. There's a name for that. It's called a doji. Basically has the same open and same closing price. And that's essentially where we are today, as the day pretty much hasn't moved. We're basically at the same price that we were yesterday. Now, like I say, earlier in the day, we were up a little bit, and then we're down a little bit. Right now, we're just pretty much flat. This is not a surprise. If you were with me yesterday and you heard me talking about where I think things are going and how we're going to be transitioning and either really breaking out to completely terminate this bearish trend, or maybe this is just kind of hanging out while we're about to get the next wave. If you were hearing all that discussion yesterday, this is what we would expect to see. What we would expect to see is little small candles at these turning points. And I haven't gotten into the moving averages as far as support and resistance are concerned, but moving averages also work as a support and resistance. So when you see a little small candle on an average like you're seeing right now, that's actually very often an early reversal signal. It's an early warning that we're about to reverse from that turning point. So very interesting what we're shaping up for today. It is a holiday week. We're going to hit Good Friday on Friday. And so no trading on Friday. It may be that we've got some kind of preemptive gearing up for that. That sometimes happens on a holiday like this as you're going into a 3-day weekend. So we'll see where things go from here. My hunch is either later this afternoon or tomorrow, I think we'll get going a little bit more. But today, I wouldn't be surprised to see a completely flat or mostly flat trading session here. All right, let's come over to the S&P 500. You're going to notice the S&P is pretty flat as well. Up 7 now. It's moving as we're speaking. But very, very small little green candle, as it's just a slightly higher tick than it was open, but mostly one of those doji candles here as well. Very, very small, and in a good location for it to turn and go down. So honestly, the forecast we talked about yesterday, where we said I could easily see it putting in a new shorter term lower high, and then continuing bearish, and that would start to establish our trend. That whole conversation we had yesterday. Well, this is very often the beginning from a candlestick standpoint. This is very often the first candle you'll see in that sequence. So I'm not saying we're going down from here. I'm definitely not saying that, because I'm still pretty optimistic that we're going to get some traction. But I'm just telling you that this is how it starts to shape up. So we're just going to kind of keep an eye on that. And then finally, we'll come over here to our NASDAQ. This is the NASDAQ composite. And again, it's up 64 right now. But a very small candle, relatively speaking. And certainly considering the volatility that we have had, all of these, it's actually a good sign, because it shows that the volatility is coming down, shows that the uncertainty is coming down, and maybe some more stability is coming into the market, which a lot of you are going to like. Let's come over here and check our VIX index. I told you, I think it was yesterday. Yesterday was Monday, right? I shared with you yesterday that VIX has only been going down, right? We spiked a week ago, and we've only been going down since then. You can see it here as the VIX is coming down. What does that represent? It represents that the uncertainty is coming down. And so the volatility is starting to leave. And you can see your oscillator here. If you were to apply technical analysis to the VIX, you can see that it's heading down as well to basically support that forecast that the volatility is coming down. So all things considered, I feel like actually we're going in a pretty good direction in terms of just getting the market reset, restabilized. And I think hopefully in the next 2 or 3 weeks here, we'll have an easier market to trade. For those of you who are not used to trading so much volatility, for those of you who like volatility, it's been a dream the last couple of weeks, right? But for those of you who want something a little bit more stable, I think stabler, more predictable times are on the short-term horizon. At least that's what I think is going to happen. All right, if you got any questions about that, type it in here. Let me come over here and see what we've got in terms of chat. Hello, Bill. It's great to see you as well. Anybody got any questions? Just punch them right there in the chat. And got a handful of people over on Rumble, but nobody's chatting right now. So if you decide to chat with me, I'll try to answer your questions. All right, let's jump into day number 16 of the Pick Winning Stocks Challenge. And as I said just a moment ago, this is by far one of the most important conversations we'll have. And I'm going to try to keep it somewhat concise because it's so important. You know, sometimes the more important the message, the shorter it needs to be. You know, it's like if you're in danger for your life, the message needs to be run. You don't need an explanation, just run. The shorter, the better, right? This is one of those messages where, honestly, I think the shorter, the better. If we can get this message that we're going to talk about today ingrained in your mind, and it will become second nature for you, it will transform your ability to preserve capital, which by default will transform your ability to be a great trader. Because as I talked about yesterday, you know, not understanding the risk management piece is one of the biggest leaks to your trading account. You can actually, I've coached many, many great traders who could really pick a winning trade. They knew the direction of the trade. They could do world-class analysis. They could apply incredible strategies. In fact, I'll tell you a story here. I got a client that I worked with for, I probably worked with her for 1.5 years. And she was an older lady. When I say older, if I told you how old she was, you probably wouldn't believe it. She's going to be 90 this year. Okay, so this was a couple years ago. She was like mid-80s when I was working with her. But this woman, she could understand option strategies like you wouldn't believe. And she understood analysis really, really well. She did a great job of picking that. But this piece of understanding the risk management was something she really struggled with. And so we had to really dig into that. And that's what I want to share with you. You know, when you look at the total blueprint of the formula, identify the trade direction, there's your analysis, apply a winning strategy, and then manage your risk. When you look at the 3 pieces of the formula, all 3 of them have to come together. When I work with my private coaching clients, all 3 of them are the process that we work through. We go through all of them. We start with the analysis, we move to strategy, and then we go straight over into risk management. All right. So with that said, let's get into the risk and reward piece. Let's talk about what I call the 3 levers of risk management. We're going to talk about the first one today. You can probably guess the next 2 days will be the next 2. So today we're going to talk about risk reward. The next one is going to be risk per trade. And the third one is risk scaling. These are the 3 levers of risk management. When you deal with managing the risk in your trade, every one of these is a risk management tool that will help prevent you from going broke. And if you do these 3, then it's kind of like the formula within the formula. The part of the 3-step formula, you know, where we talk about the 3-step trading blueprint, the part of that where you don't go broke is right here. It's these 3 steps. So it's the formula within the formula. And today we're going to talk about the first one, which is risk reward. And here's the first principle you need to write down. Principle goes like this. You need to have a greater reward than you have risk on every trade. You need to have a greater reward than you have risk on every trade. If you risk more than you are going to make, over time you will go broke. That's why it's essential to have a greater reward than risk for every trade. And here's the flip of that. If you do this, you will win. If you have a greater reward than you have a risk on every trade, if you will do this principle, you will win. Eventually. Maybe not every trade, but you will win. One of the things that I often tell my coaching clients is you have to think about trading, and specifically the risk management piece. This is not gambling. This is the opposite of gambling. When you think about the risk management piece, this is the thing you can control. You can't control if the trade's going to do exactly what you want. You can't control that the Federal Reserve might come out and make an announcement that shocks the market and it sends things going the opposite direction. You can do all of your analysis. You can say everything's set up to be going in a good direction, but there's outside influences that you have no control over. You can't control high-frequency traders. You can't control if a fund decides to come dump a bunch of positions. There's all sorts of things you cannot control in the market. One thing you can control is your risk and reward. That's why I say this is the part where you really get control and you really get it dialed in. I think it was last week, maybe it was 2 weeks ago, but sometime in the last 2 weeks, I did in one of these sessions, I talked about how trading is not gambling, but there's a lot you can learn from gamblers. This is one of those pieces. What a good poker player understands is how much they can risk for every hand. And if you don't risk too much, then you live to in that case, play, in this case, trade another day. You can continue going really indefinitely so long as you manage the losses effectively, okay? So here's what often happens. Let's talk about some confusing aspects of this. People think whenever I use the word risk that it's the same as capital, and it is not. Risk does not equal capital. Let's define our terms. Capital is the amount of money required for you to participate in the trade. Capital is the amount of money required for you to participate in the trade. Risk is the amount of money you are actually willing to risk on the trade. Notice the difference. Capital, amount of money required. Come on, slides, work for me. It'd help if I push the button, right? Amount of money required for you to participate. Risk, amount of money you're actually willing to risk on the trade. You say, well, how do I know? The answer is, here's the formula. Your entry price minus your exit price is your risk. This is truly a formula that I'm giving you. This is something that you can run the numbers. You say, okay, I can get my mind around this and it's tangible. And if you'll run these numbers as part of your risk piece, the scary part of trading actually disappears. Because the scary part of trading is that you're going to go broke. The scary part of trading is that you're going to place a trade, you're going to lose your money, you're going to lose everything. That's the scary part of trading. This is the tangible thing that you actually can control. Most of us in our society are control freaks. We want to be able to control everything. Unfortunately, the stock market's not something you can control. All you can do is maneuver. It's almost like a martial art, like the art Aikido. If you've ever looked at the martial art Aikido, I watched a guy one time, I'm trying to think where it was, but I was at a personal development seminar one day, and they brought in a special guest, and this guy was a Aikido instructor. And he talked about how in Aikido, you don't necessarily make I'll call it the offensive move. You're not necessarily going after the opponent, but rather you take the opponent's energy and you turn it against them. That's the way trading with a trend is. When you're thinking about momentum trading, like we've been teaching you here, when I teach you about trading with the trend, trading with momentum, what you're doing is you're letting the market tell you where it's going, and you're jumping on and you're using that energy in your favor to beat the market. So you're using that force in your favor, but it's not something you control. You can't be offensive in that. You don't have control of the offensive move. Rather, you're being somewhat defensive and using it in your direction to your advantage. Risk management is the opposite. Risk management is something you can completely control. This is the piece that you can be nutty about and say, okay, did I manage what was in my control? And when we talk about the risk and reward, risk is the amount of money that you're willing to actually lose on the trade. And the way you define that is your entry price minus your exit price. The reward, this is the amount of money that you expect to make on the trade. Risk is what you are willing to lose. Reward is what you are planning to make if the trade does what you want. And the formula is simple. It's your target price minus your entry price. Target price minus your entry price. That's going to equal your reward. So what I want to do is I want to go over to a chart, and let's work through this. And what I'm going to do is I'm going to pull up, we'll just pull up our QQQ chart. And let's get rid of all of our lines for now. And let's just assume, for the sake of having fun, let's get rid of our moving averages too. Let's assume that we're going to enter this trade right here at 470. We'll put an E here for entry. Let's assume that so long as the trade is going in our direction, we will be in this trade and we will be happy. And we're going to trade it up to target number 1 and target number 2. We'll make those assumptions, okay? But if the trade turns against us and starts to head down, at some point we want to stop out. So let's define that stop point for this conversation as this swing low right here, which is about 440. And I'm going to annotate that with an S for stop. Now let's mark our targets. This will be target number 1. And we'll mark that as it's almost 500. So for round numbers, we'll say 500. We'll call that T1. Next, there's a whole lot of support happening right here. So we'll call that T2. That looks like it's about 515. That'll be target number 2. And then getting all the way up here to the top, it's about 540. We'll call that target number 3. Now, based on this information, you can create your formula. The difference in your entry and your stop is your risk. So in this case, your risk is $30 per share. The difference in your entry and your target is your reward. So we have 3 possible rewards. One of them is 500 minus 47, so that would give you a $30 reward, $30 per share. One of them is 15 minus 470, so that would give you a $45 per share reward. And one of them is 540 minus 470, so that would give you a $70 per share reward. Does everybody understand that? So each one of your targets has a different ratio of what your reward to your risk is. Now here's where people get really messed up. If you come in here and you place a trade, and let's say you enter the trade at 470 and you got to stop at 440, and the best you expect to do is get to 500, that is a ratio of 1 to 1. You're literally you're planning, hoping to make as much as you're putting at risk. Best case scenario. 1 to 1 reward to risk ratio is okay if and only if it's a target on the rest of the journey. But if that's your complete trade, and let's say that you go place 10 trades where you're only making a 1 to 1 reward to risk, you're going to go broke. And I can guarantee it. Statistically speaking, if you go out and you place a bunch of trades where you're putting $1 up for every dollar you're putting at risk, you're expecting to make $1. It's a 1 to 1 reward to risk ratio. If you do that, you will eventually go broke. You'll notice the second targets here is better than 1 to 1. It's about 1.5 to 1. And the third target is exactly, well, almost exactly. It's a little bit better than 2 to 1. It's about 60 would be 2 to 1, so we'll call it 2.2 to 1. So if you get to your ultimate target up here, your reward is twice. If you get to your ultimate target, your reward is twice what your risk is for this trade setup. And if you carry that forward, and if you win half of your trades, making a $2 reward for every dollar you put at risk, and you lose half of your trades, losing $1 for every $2 reward you get, you'll never go broke. This philosophy of reward to risk management will transform your trades, because here's what most people do. Most people don't, first of all, most people have no clue. They have no idea what they're doing. But when they do place a trade, here's what they'll do. They buy. And there's your entry price. You say, what price did you get in it? I got it in as cheap as I could get in, sir. Okay, you got in at $4.60. Okay, perfect. We buy. Where's your stop? And they say, I don't have one. So what happens when the stock does what it's done this week? It just keeps going down and down and down. Where do you get out? How much risk are you putting on the table? They say, I have no idea. $460 a share? How many shares did you buy? 100? $46,000? Okay. That's quite a bit of capital that you put at risk. You willing to risk all of it? Well, eventually it'll come back. I'll just buy and hold it forever, right? No, this is not a trading plan, people. But that's what most people do. Then you say, well, how high are you going to trade this? And they say, oh, as high as I can trade it. But then what happens is start working its way up. And they say, oh, I've got a profit. First time in my life, I have a profit. And they end up closing it up here for about $4.90. And they're happy because they actually made a profit. But what they don't realize is they cut their profit short. They're quick to take profits and slow to take a loss. You got to learn this lesson. You got to learn it early. If you're quick to take profits and you let your losses run, you've got to flip it. You need to let your losses get cut and you need to let your profits ride. Now, you don't want them to ride forever. I mean, you want them to, but you can't do that because eventually you need to decide where you're going to take your profit. Sometimes there's certain scenarios, certain strategy techniques that we'll use where we might let it ride for a certain amount and the exit target keeps shifting higher. There's a scenario where we would do that. But for the most part, whenever I teach you to do trade setups, I'm going to teach it the way I just showed you right here. You'll have your defined entry price. You'll have your defined entry and you'll know exactly what your target is on the way up. And now you know if I get to my target, I'm going to make $2 per share for every $1 I'm putting at risk between my entry and my exit, my stop. Now you're shifting the algorithm. It's not really an algorithm, but you're shifting the focus. Again, what most people do, and this is why most people go broke, what most people do is they buy and they hold on for dear life, but eventually dear life they can't sustain anymore. So they hold on as long as they can sustain it. They eventually sell it in a panic, and they took a huge loss, 30, 40, 50%. And then when they finally do go back in and they buy, they'll ride it up for a little bit because they finally have a profit, they take it. They're afraid to take the loss, and they're too quick to take the profit. Let's go over here and look at some cryptocurrency, and I'll show you some examples of this. Crypto is the most extreme marketplace that this happens. I promise. I can tell you where profits are being taken. Okay? I can tell you based on volume. Look at this huge volume spike. What was this? This was incredible buying pressure. People are buying, 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 buying. Up here at the top, somebody is selling. You know, that's an important point to make. Do you realize that when you see volume, in order for a transaction to occur, there must be both a purchase and a sell. So if you're buying in a rally and you're at a market high, and you're buying the stock, or in this case, you're buying Bitcoin, the question is, who's selling it to me? Because if nobody's selling, the price will just skyrocket. Nobody's wanting to sell, so the price just keeps going higher and higher and higher. So the question always has to be, if I'm buying after a market high, if I'm buying, who's selling to me? Why are they selling? What do they see that I don't see? You want to be a more effective trader, you got to flip the script and understand the opponent. You got to understand who you're trading against. And it's not like it's a battle, it's not a war, but you have to understand who your counterparty is. If you're buying, why are they selling? If they're selling, why are you buying? Understand? Flip it on the other side. If you're selling, why are they buying? What do they see that I don't see? Most traders, as we talked about already, most traders get in at the top and out at the bottom. It's the informed traders who can flip the script and get in at the bottom and out at the top. That's what the informed trader does. But the average, normal, everyday retail trader, the reason you feel like the deck is stacked against you is because you're buying at the top and selling at the bottom. So here's what happens. When you look at these volume bars, which are in here, you see all this surge of volume. Tons of buying pressure came flooding in. Because you had a lot of retail traders that were sitting on the sideline saying, oh, Bitcoin's moving, I'm jumping, I'm going to jump in. And we saw so many people jumping in. We get up here to the top and look at the volume, it all starts to die off, right? Then we get into this little corrective move here, and look what happened right here. Look at these big volume spikes. A bunch of selling happening on those dips, isn't it? This dip right here had selling volume spikes. So what that's showing you is the people who were buying all this low volume right here, the people that were buying up here, panicked here and sold. Now, maybe not all of them, but a bunch of them. That's a 15% drawdown. That's 15, 20% that they just literally just flushed down the toilet because they couldn't hold on any longer. And some of you are those types of traders. If you're not that trader, then you know those types of traders. I'll use a personal example. I got a family member. I love him to death. He's always on the wrong side of the trade. Always, 100% of the time, guaranteed. Because the only time he ever asks me about a trade is after it's too late. He'll call me and he'll say, hey, I saw that this stock, or in this case, crypto, actually called recently about Bitcoin. Says, hey, I hear Bitcoin's over $100,000. Do you think we should buy? What do you think I said? I said, you do what you want to do. I can't tell you what to do. But I did say it's going to pull back and it would be better to buy it cheaper. Because I understand how the cycles work. What happens when we get to a market high like this consolidation period up here at the top that we talked about a couple weeks ago, when we get to a market high like this, the very people who started to move down here, the informed traders who started this accumulation period back here, this was the public participation part, they're the very people that are selling and distributing their positions at the top. Well, if they're selling, who's buying? And the answer is, it's the average everyday retail trader. So what happens for most people, most traders, what they will do, they're late to the party. Number one, their plan is, I'm going to hold on for dear life, aka hodl. And then when the pain is too much, they sell. So they're getting in up here at the top. They're never really seeing a profit. And then when it's down 15, 20%, they sell in a panic and they get out. And then every once in a while, one of those people will buy in an opportunity like this right here. Every once in a while, they'll buy here. They ride it up from 58,000 to 68,000, and they say, whoo, that was a doozy. I got a profit. I'm taking my money. They take their profit out, and they run. And what ends up happening is if you average out their trades over time, the trades that they win on, come on, pen, do it for me. The trades that they win on, they'll end up making $1 to $2 per share. And the trades that they lose on, they'll end up losing $4 to $8 per share. And then they end up calling me saying, hey, about half my trades make money, but I keep losing money. Why? And every time I say, probably your risk management. Now, I'm using these as examples. They're a little bit extreme, a little bit passionate because, you know, the better I tell a story, the more it ingrains the idea. But the question is, do you know anybody, maybe someone you know intimately, maybe somebody you've seen in the mirror, who might have done this, where they're consistently cutting their losses, or excuse me, cutting their profits short and letting their losses run for too long? And if you know somebody like that, then you know why their trading account keeps going the wrong direction. When somebody calls me for coaching and they say, hey, I don't understand, you know, I'm making money on a lot of trades, but my account equity curve keeps going down. This is always where it is. That's why I say this is one of the most important lessons we'll give you. Okay? All right, let's come over here, and that's not the screen I want to do. I want to do this screen right here. Let's do a trading plan. What is in your trading plan? Your trading plan must have 3 pieces of information. It must have your entry price, your target price, and your exit. Your entry, your target, and your exit. These 3 price points will give you everything you need to identify your risk and your reward. Now, I kind of just went through all this in our example over here, but we're going to do it again. Let's say we stuck with this Bitcoin trade. And it doesn't matter if you're trading Bitcoin by buying a whole Bitcoin or if you're buying a fraction. The trade setup is the exact same. Let's say you decide, hey, when this trade moves up, I'm going to buy it, and that's going to be my entry, and that number is 88,000. Okay? Well, where's my target going to be? Well, I'm going to suggest to you that your next target is going to be up here at the top at 108,000. This is how you do it. Okay? There's your target. That's your entry. You say, well, where am I going to get out if things go south? If things go south, I would absolutely say your most recent swing low. In this scenario, because it's been in a bearish swing, if it continues to turn back down, you probably want to bail early. So I'm going to say right here, 80. That's going to be your stop. Oh, I just wrote that backwards. My dyslexia is kicking in. 80K. Now you have your entry, your target, and your stop. Now you know your trading plan. Now I'm going to say this. If you don't know your entry, your target, and your stop, you do not have a complete trading plan. As I said, there's one technique that I will teach where you don't define the target the same way. And you do let your profits run longer. But in 99% of the scenarios, this is how you're going to do it. Your entry, your target, and your stop. You never want to trade without a stop. You're just letting your losses stack up. It's just too risky. But here's the thing. Now that you know this, now that you know the formula, now that you know what goes into it, you can plan. And you say, okay, if I buy at 88 and I stop out at 80, I'm going to lose $8,000 per whole Bitcoin. But if I buy at 88 and I trade it up to 108, I'm going to make $20,000. Well, 20 is more than twice what I'm putting at risk. So the question is, would you make 20,000, or would you take 20,000 in exchange for risking 8? And this is where the psychology comes in. Would you risk 8,000 to make 20, or is that too big of a risk? If the answer is it's too big of a risk, then I'm going to tell you, you have no business trading because there's no free lunch. People want there to be a free lunch, but there's no free lunch. They always think there is. One of the reasons that traders lose money is because they think in their mind it's always going to go up, but that's not reality. You have to plan for it to go against you. And if you have planned that for this trade, I can lose as much as $8,000, now you know. And before you ever execute the trade, mentally you say, okay, this is how much I'm putting at risk. If it works, I'm going to make 20. If it doesn't work, I'm going to lose 8, and I'm comfortable with it. And if you can be comfortable with it before you place the trade, now you're ready to place the trade. But if you can't be comfortable with it, don't do it. You should never place the trade if you can't be comfortable with it. Okay? Now let's talk about those ideal numbers. You must have a higher reward than risk. Ideally, you would get to 3 to 1. Ideally, you're going to receive a $3 reward for every $1 you put at risk, but it is acceptable to do 2 to 1 if you have to. I will never set up a trade that is less than 2 to 1 unless the ratio of less than 2 to 1 is a target on the way to a better target. So for example, the very first version I showed you, the first target was 1 to 1. Well, if I thought the 1 to 1 was going to be the final target, I won't set that trade up. It's not worth it. But if 1 to 1 is a stopping point on the way to the ultimate target, and let's say that ultimate target is 3 or 4 to 1, then it's worth taking the risk of the 1 to 1 trade. And I set these up all the time on Sunday nights. The people who in my Sunday night classes will tell you, I'll be in the middle of a trade setup. Usually I don't do this because usually I've thought through it all before we get there. But sometimes I'll be in the middle of the trade setup and I'll say, oh man, that's like $1.20 to 1 reward to risk ratio. You can't do that. And we'll just throw the whole thing out because it's too big of a risk. Or I may set the trade up and say in the notes, not a good reward to risk ratio, because it still might be a decent trade setup in terms of the picture, but not for a regular long trade. You might have to use a different strategy, like a option short trading, for example, like a credit spread or naked options or something where you're receiving premium as opposed to buying. So there's other strategies you can use if the risk reward's not there. But if you're doing a basic long trade, you're buying the stock, you're shorting the stock, you're buying a long option, or you're buying the crypto long, if that's your basic trade, then you must follow this formula, and I'm going to show you why right now. This is the spreadsheet of what happens. Understand. Before I even go through this spreadsheet, understand your basic odds of making money in the market are 33%. Period. If you just throw a dart at a list of stocks and you pick a random stock, I'm going to go buy, oh, it's IBM, let's buy it. You have a 33% chance of making money. Now, if your risk reward is upside down, you're going to lose money every time because the odds are against you. You must win 67% to break even. It's never going to happen. I mean, it might happen, but it's really hard. And that's a break even. Beat market odds by twice and you barely break even, that's terrible. But if you flip the reward to risk ratio, let me show you what happens. So if you have a 50-cent reward for every $1 you put at risk, you have to win 67% of your trades just to break even. You have to literally double market odds just to break even. Hard to do. Hard to do. So people who do this, people who will risk $1 to make 50 cents per share. I'm using simple numbers here, but you can extrapolate it. In my Bitcoin example, it would be we're going to risk 8,000 to make 4,000. Make sense? So people who do that, which happens all the time, they don't realize that they've got to win basically 100% of their trades to make money. That's why people are so opposed to losing, because they don't understand. They've got everything upside down. But watch the formula here. If you just go to 1 to 1, you only have to win half your trades. You say, well, that's still better than market odds. You're right, which is where 2 to 1 comes in. If you only manage a $2 reward for every $1 you put at risk, and you just win basic market odds of 33 to 34%, you will break even on your account. That means with a 2 to 1 reward to risk ratio, if every trade that you take either wins you all the way to your target or it stops out and your reward is $2 per share and your stops are 1, over the course of 10 trades, you will break even with a 2 to 1 reward to risk ratio. You could lose 7 out of 10 trades and still break even. That's why I say it's a formula. We're starting to manage as opposed to feel our way through. Basic market odds, throwing a dart and hitting a stock on a board. You can break even if you have the right risk reward. Let's keep going down our spreadsheet here. If you have a 3 to 1, you only have to win 25% of your trades. If you have a 4 to 1, you only have to win 20%. And if you have a 5 to 1 reward to risk ratio, you only have to win 15% of your trades to break even. This is how you stack the odds in your favor. This is how you give yourself an edge. You give yourself an edge by controlling something you can control. You can't control what the Fed's going to do. You can't control what the news media is going to push out, what the president might say. You can't control a lot of things in the market. But what you can control is your risk management. And here you're starting to see the formula for it. Okay? Now, imagine if you're just trading basic market odds of 30% and you manage a 3-to-1 reward to risk ratio, you only have to win 25%, you're going to start to see your equity curve going up, even if you had terrible analysis. just basic market odds, you're going to see it. But what if you stack in, thinking through our 3-step blueprint, what if you stack in really good analysis, which is what I started teaching you 2 weeks ago? What if you stack in really good analysis? And what if we increase your basic market odds from 33% up to 50%? Now you win half your trades, but if you keep a 2-to-1 reward to risk ratio, your equity curve's going up. You're blowing it out of the water. What if you improve your analysis a little bit and you get it up to where you're winning 60, 70% of your trades? With a 2-to-1 reward to risk ratio, your equity curve's going up even faster. Doesn't mean that you don't have losing trades. You're still going to have losing trades, I promise. I still have losing trades. Plan for it. Just plan that you're going to lose trades. So when you plan for it, you say, for every trade that I lose, I'm going to lose $1 per share. And every trade that I win, I'm going to win $2 per share. And as long as I'm winning 40%, 50, 60% of my trades, my equity curve is going to be going up over time. And that's how you beat the system. That's it. The reason most retail traders can't beat the market is not because it's unbeatable. It's not because it's too hard. It's not because it's rigged. It's not because high frequency traders. It's not because of the market maker. It's not because of any of that. The reason most retail traders can't beat the market is because without realizing it, they're sabotaging themselves. They don't know how to do analysis. They don't know how to apply the right strategy at the right time. And they don't do good risk management. And if you fail on all 3 of those pieces, you're going to fail. But if you learn each of those pieces, risk management, pretty darn easy. It's just a formula. Strategy, actually remarkably easy. Analysis, you can let it be easy. It doesn't have to be hard. I've already shown you the moving averages. I've shown you the system, the entry system. There's others, more complicated trading systems, more complicated types of analysis, but I've already shown you how you can match and beat the market just using the moving averages. And if you do that and you pair in accelerated strategies and you pair in refined risk management, over time, you'll start to see your equity curve grow. That's why the formula works right there. All right, let me give you some action steps. I want you to look at your trades that you've been considering, and I want you to ask the question, what is your reward to risk relationship on those trades? What is the reward to risk relationship on those trades? And do some analysis. Ask yourself, what have I been doing to myself? Have I been self-sabotaging? Have I been managing it? Is there a reason I'm losing more money than I make? Probably. And it's probably one of these factors right here. So stop it. Reverse it. Do it the right way. All right, folks, that's what I have to share with you today. If you got any questions, type it in here to the chat. Type it into the chat. If you've not liked and followed and subscribed, by golly, do it. Let me check over here on our Rumble, folks. We got a handful of people watching, but no comments or questions so far. If you have any questions, type them in there, folks, and I'll give it my best shot to get it answered before I finish here. Tomorrow, I'm going to go into step 2 of the risk management formula. Today, I gave you the first piece. I said it was the most important. It is. Tomorrow, I'm going to give you the second piece. It's the second most important. The next day, I'll give you the third piece. But this one right here, reward to risk management, is so stinking important. So learn it, memorize it, lock it in, and apply it to your trades. Miss Loveland, how are you? She says she needed this today. Thank you. You're welcome, love. Glad that I could give you exactly what you needed today. All right. No comments over here on Rumble. You guys are a quiet crowd. I'm happy you're with me, but quiet group. Let's see. Nothing over on Facebook, so I guess that's going to complete us, folks. I want to thank you for being here. Again, if you haven't liked and subscribed, do so. Tomorrow, we'll get into the next step of risk management. Until then, I wish you the best. Happy trading to all of you, and we'll talk to you soon.